Welcome to your Friday closing bell. Coach Boyer, Jason Jacobi, Salt and Pepper. We are here live on a holiday shortened week. Coach Boyer with a big B. You ain't boring like we said last week. Are you ready for another edition of the
I don't know
closing
where the
bell?
Coach Boyer thing came up, so I just added that in today. So feeling like a coach right now. Maybe it's a football playoff time. Maybe that's why. I don't know. But anyway, Coach
Maybe,
Boyer.
but you're coaching and educating people on the economy and fixed income, stock
Yeah,
market. So it
yeah,
applies. It
I
applies.
suppose. Yep,
You're
it
still a
does.
great coach, right? So
Basic life stuff. Coaching on life things. Finance
absolutely.
is a big part of that.
Yes, absolutely.
Not the
It's a
biggest
huge,
part, but a big part.
absolutely.
Yeah.
All right, so we got a good one for you this week. Our theme of the week, which we want to kind of talk about. So we're just trying to figure out how to best optimize our time with you all watching or listening. So we're navigating market highs. We got tech triumphs and global economic tides, which are always turning. The world is a turning. So S&P on track to potentially close at a record, which dates back to 2022, which is fantastic. Mark, uh, obviously we've seen a quite an incredible run in the tech sector. We talked about the rise of the tech era again after the dot-com bubble, Internet 2.0. I feel like this is kind of Internet 3.0,
Yeah.
semiconductors. Give us your thoughts.
Well, yeah. I mean, I think we're getting some good news. Out of Taiwan Semiconductor came out. Just within the
This
last
week.
48 hours,
Yeah.
basically, and they kind of blew earnings away. Their first quarter revenue guidance, was 18 billion, 18 to 18.8 billion, and which implies a 10% increase over the 16.7 billion recorded in the first quarter. So, management's with Taiwan management believes that their full year 2024 revenue will increase by low to mid 20% rate of return. That's
Jeez.
incredible on dollar terms. So semiconductors are they're cyclical, right? I mean, I think so. There's semiconductors in everything we use today. It's crazy,
Yeah.
like they're everywhere. AI is the big thing now because AI is another whole. We talked about this in former, podcasts or
Mhm.
on here on the closing bell. But the fact is we all know semiconductors are everywhere, and Taiwan Semiconductor, because of their location there in China, has been they've always been a big area of manufacturing and of semiconductors coming out of that area. They've expanded. We talked about this before. They've expanded now. They're opening up plants in the U.S. in different areas, and so they're because semiconductors are sort of a forerunner to actual economy. A lot of people look like when you see semiconductors starting to say, hey, we've got more increases coming. We've got more people buying semiconductors. It possibly gives you an idea of what's happening in the economy. So all said is that when somebody like Taiwan Semiconductor comes out with these kind of numbers, it bodes well for everybody. If they're growing
Yeah.
demand with semiconductors means that lots of companies are ordering those semiconductors to put in their products or whatever. So anyway, that's part of the deal. And so you're seeing, this it's relatively, it's a bullish sign for the market. And here at the end of the week here, we're getting some, especially in the NASDAQ and
Yeah.
we're busting out to new highs. NASDAQ actually today, Friday, this is Friday's busting out, not to new highs, but over a short-term sort of area that it's had a little bit of resistance at. So that could be
Okay.
positive going over the next few weeks. We'll see how that plays out.
And just want to touch on Taiwan Semi again, because that was something that a company that I was quite fond of the past 2 years has kind of severely underperformed the rest of the semiconductor space because of China's influence, China kind of saber rattling, saying that the reunification of Taiwan and China is inevitable. That's what he said this past week, President Xi of China. So whether to be seen if they want to start World War III or, how that kind of affects and elevates more geopolitical tensions, not only in the area, but around the world. which we'll kind of get into a little bit later, that had a serious effect on investor sentiment. It's like, do I want to buy Taiwan if they get taken over by China, which will have their kind of fingernails kind of ingrained into the company at that point? But Taiwan Semi, a lot of people don't understand is they've been deglobalizing their supply chain, which is very key. I think since COVID, a majority of your companies out there are looking for ways to deglobalize their supply chain. Take, for example, what's going on in the Red Sea and the Suez Canal right now. Companies are also looking for ways around that because that is such a major hub for shipping containers and oil exports through the region, and imports, depending on
Yeah.
which country you are. So I think you've seen that decoupling from globalization to deglobalization. You got Taiwan Semi now in Arizona, though now they're having trouble finding people to fill those jobs because they don't have the training. So they're having to send the Taiwanese over here to train the U.S. Citizens and workers to make these chips because they're the largest chip manufacturer in the world, chip foundry, excuse me. But again, not only here in America, but they're looking to open other factories all over the world. So again, as we get away from that kind of overarching theme of the Taiwan China narrative, then it could be really good for Taiwan Semi, and it could kind of join and catapult and catch up to the NVIDIAs, the AMDs, Intels, even Supermicro now, which blew up today, up almost 36%. So, like you've been saying,
they didn't come out with
nice
earnings. So another AI kind of stock that, again, will possibly benefit from increased exposure there and, this bullishness in the semiconductor. So anyway, all that is right. You're talking about there's an expanding there, China. It'll be interesting to see geopolitically what China does, because they had the elections that this last week or so that, didn't go in China's favor. Taiwan really wants to be separated and kind of go with the West in a lot of ways, continue there. And that's, we'll see what leadership in China decides to do. So, you could hear about more saber rattling right now. So it's going to be interesting to see. But as far as the market today and where we're at, I mean, based on those numbers, don't forget, China's in a pickle too. Their economy is in the toilet. They're not doing very well. They've got commercial real estate issues like crazy.
Consumer demand's low.
Consumer demand's low. They got jobless rates, especially amongst young Chinese, that want jobs, so can't get them. So there's a lot of negatives going on there that's causing them to, to try to get their house back in order. And then you're talking about these attacks in the Red Sea, right? A lot of that's Chinese goods going out, another headwind for them. So you got Taiwan and then semiconductor coming out with positive news. It's like holy, they don't have a lot of good news going on there. So we'll see what happens. I don't. They're kind of they're in a pickle right now, just with all of what they've got in store and what's happening there. And to your point, and so because of that, like you said, I think the key thing to take away here is that a lot of people are looking for diversification away from being so strong, in need of what China has to produce. So they're going elsewhere. And, so that's a good thing, and that's a good thing.
Yep, absolutely. So let's talk about earnings season. Q4 earnings season's kicked off. And it's been a little bit of a mixed bag at this point from the banking sector. Some financial giants did surpass expectations. Others signaled caution ahead with projected dips in net interest incomes. But there's a silver lining. The S&P 500, like we had mentioned, it's on track to potentially close at a record high here. Their forward earnings estimates are way beyond the 2022 peak. So it's painting a potentially rosy picture for stocks. But again, we've gone into this quite a bit already. This year, again, always election years are more volatile, more geopolitical headwinds. Is inflation going to rear its head, which we can talk about due to supply chain issues or because of supply demand, more on the supply side for the US? moving forward. It's going to be an interesting one.
There's a lot of moving parts, right? I mean, that's part of so it's there's so much to look at and to analyze, and again, yeah, and that's the excitement about this um, profession that we're in, and when investing, it's you keep your eyes on all these things, but bottom line is nobody really knows what's going to happen tomorrow, but you can see trends happening, and right now, this. Like you just said, it looks like we're headed to new highs, or at least potentially there, especially here at the now in the S&P, and then with the Nasdaq, if it gets to its former highs, and then we're able to break that, like it or not, that's actually trend wise. I mean, the trend is to the upside. Even though we're more expensive, stocks P ratios are higher, means all that, but it does mean that if you have exposure right now in the markets, it's important to be diversified, but it's important to not to be panicking out at the moment. But that's for now. That's this week. So, but that's looking pretty positive. And again, I can't emphasize enough that the semiconductor being cyclical, this whole idea is actually an early indicator that the markets and that the economy does look pretty positive, which then counter to that is going to cause, everybody's talking about rate decreases, right? That's what the Fed was talking about. December going to increase. The market, I think, overshot the bond market. There was talk about 6 maybe rate cuts in this year, which, who knows, again, anything's possible, but that seemed to be over, it might, still think the rates are going lower, that the Fed will cut eventually, but may not be 6. And so thus you're getting a little bit back up in 10-year yields to the, above 4%, 4.1, 4 point, it looks like, somewhere in that range right now.
Yeah.
So, a little bounce back to its 50-day moving average. And so we'll see how that plays out. But anyway, a lot of fun things to look at.
Yeah, watch. Market's pricing in 50-50 rate cut here in March. Again, I would not be surprised to see if they even hold off on March. Obviously, we're still early here, but with retail sales numbers that came out this week, it showed a 0.6% increase, which was actually quite a bit higher than they thought for December. Again, it's the holiday season. People still spending strong at the end of the year, showing consumer resilience. Now, the numbers of delinquencies that we see this year will kind of be a byproduct of that. Is it actually going to play out where it's more widespread, or is it going to be a soft landing and potentially not be as severe as we once thought? So that's a good thing. It could, again, consumer spending could increase GDP growth, right? But again, it could stoke inflation. Again, we had inflation numbers that came out last week. If you didn't watch or read in the news, it kind of had a little bit of an uptick as well, and a surprise on the upside. So we potentially see those numbers coming back down over the next month or two. But again, that the Fed will be data dependent. So, but the main thing that I want to talk about, besides kind of the consumer on the retail side here, but the housing market. So let's talk about different kind of buying and selling homes. We saw a 20-year low, 28-year low for the 28-year low for existing home sales. Okay. So 23 years ago, that was like 2001, 2001, since we're new in 2024.
How old were you? About 10?
Yeah. It's about 10.
Right? Okay.
Yep.
There we go.
Exactly. Don't tell the audience that.
I won't tell you how old I was. Anyway.
But yeah, so we had a housing low. Obviously, we're not telling you anything new here. We're telling you basically what we all knew and what the real estate market's been telling you for a long time as well, that it was tough. Inventory was low. People didn't want to sell if they had existing mortgages in the 2 to 4% range. And that put a lag on the existing home sales. So nothing to write home about there. do potentially see that easing up if rates do continue to go down. They already started to in the mortgage industry, but if it continues to fall, then potentially it could be a tailwind for the housing market in 2024. But again, that is to be seen.
Yeah, it's a really interesting call. I've never seen anything like it because the fact is yeah, I mean, existing sales are down, and so you would think that prices would come down, right? Because demand,
Yep.
but the reality is because of the lack of supply of homes, when a house does come on the market, there's so many people that want to jump on it. So it's so strange that the number of sales are significantly down, but the prices are not coming down, which is, we've also printed a ton of dough in the last couple of years, so there, there's a lot of money there, and so we saw a huge rise there. But at the same time, it's interesting to see that prices aren't coming down, which I don't know. It's going to be it's a challenge for people, young people, young families that are trying to buy homes, can't get into them, too so expensive. But yeah, it's going to be interesting to see how that plays out. So. I don't know. I think lower rates will help the housing market, but I think they're going to
Yeah.
have to come down fairly significant for a lot of people to get off and actually get
Yeah.
off the sidelines and selling their places. But that's my take.
That's true. That's true. The worst could be behind us. That's yet to be seen, but it could potentially be possible. Now, the last thing I want to talk about real quick here, shipping costs and global tensions. So, can you just briefly touch on, Mark, geopolitics? We've talked a lot about geopolitics. Does it really affect portfolios? Does it not? I know that's kind of a loaded question because you have short-term, long-term goals. There's a lot to play into that. But is there something like this? Let's use. We're not talking about Gaza. We're not talking about Ukraine. Let's just more focus on the more recent conflict. Again, the proxy war, Iran-backed Houthi rebels, kind of destroying a lot of container ships or taking them hostage, drone strikes, and how the UN's kind of retaliated. Now, the Suez Canal and the Red Sea, like we mentioned briefly in this podcast, it affects a lot of the shipping and oil that come through the region, a lot of the global supply. So is it a big deal? I mean, is this something real that we need to monitor for inflation purposes for Europe, maybe more than us? But what are your thoughts on that?
Yeah, I mean, I think all these things. I'm concerned when we get all these different characters and groups out there who are getting emboldened with to attack things. I just like it. I just I'm a peace through strength guy. It makes me I don't feel like we're coming across as a U.S. Very strong, and where people have this idea that they can just do whatever to.
Yeah.
Ships or whatever. So that's concerning. And I think that, you see some more tension happening there. But longer term, I just say in the short term, can things like this affect us? Absolutely. I mean, if you're a ship owner and your business is to move supplies of something from, this country to that country, and you have to go through a place that's under a lot of tension where you might get bombed or whatever, some type of
Yeah.
danger, you're not going to take that trip unless okay, what's going to entice me to still want to take that trip? Well, maybe you could give me some more money. I mean, I'll maybe do it if I'm paid more. Right. So again, so they, the shipping contract, and then they up their prices, which then in essence,
Mm-hmm.
flows through an economic system, flows through to the end use, to the suppliers. They
Consumer.
got to pay
Yeah.
more, and then it ends up that the consumer pays more. That's inflation, right? I mean, that's how that
Yep.
works. It works through it, and it's kind of like here in California. It's crazy. Like we got this minimum wage thing. I was talking, just about, some of these companies that are trying to now make it, and they've increased minimum wages, and it's, we want people to make money. I'm not saying that, but if you increase wages and, on a company and they trying to produce a food product or something, they're going to up their prices, right? I mean, they
Yep.
have to up their prices to pay for the increased wages, which then in
Right.
effect then makes us all have higher inflation. So
Yep.
sometimes, it's just how it works. It's just how an economic, it's just how economies work. So anyway, so yeah, so in the near term, inflation could be higher. It could cause problems that way. Longer term, it's interesting. Wars and different, things like that, geopolitical issues in the country. I mean, you could have those short term issues, but longer term, you know, uh, a war or a conflict causes some type of company. Those would be like defense right now, or you build munitions, tanks, things like that. They need more of them. There's a demand for that, and so you have certain companies that make more money in those kind of areas. You see it when you in World War II. I mean, I wasn't there, but my father was in World War II, and my mom, and they used to talk about how they all when all that was going down in Europe and in the Pacific, that everybody went to
Yeah.
work. Mom, the women
Yep.
here, everybody, and then the economy just exploded even to a war. So yeah, short term definitely can have moves. Long term, you know, not as big a deal, and actually can be beneficial. That's why, as investors, always
Yep.
important when you're investing to have a longer term. Determine what part of your portfolio is short term, 3, 6
Mm-hmm.
months, 1 year, even then moderate 3 to 5 years, and then long term. If it's longer term, then you don't really shouldn't sweat it. You just look for opportunities to make adjustments in those types of times.
Yep. In bad times, there's always opportunities. Oil's come down quite a bit since last year, so good opportunity, and some tailwinds and energy this year specifically. Consumer staples have taken a hit because tech's done so well. They kind of are on opposite ends of the teeter totter. But yeah, there's always going to be bad times to invest. So how do you take advantage of that? How do you position your portfolios? I think you did a great job explaining that, kind of the three different time horizons there, and then playing off your cash needs, income needs, goals, things of that
Yeah.
nature. But there's always going to be a bad time to invest. I mean, there's a lot of uncertainty in the world besides the election that happens every 4 years, the presidential election. So, I mean, how do we take advantage? Do we look for opportunity? Look for companies that maybe are kind of all weather, that can kind of maybe withstand different market cycles, and try to position yourselves in that way, and take advantage of those opportunities when they arise. So have some of that dry powder ready to go. But
No doubt.
but yeah,
That's
that's
good
that's
wisdom. That's having a good. That's why I'm Coach Boyer and you're Coach Jacobi. We got to change our names. I know we're salt and pepper and
salt,
all having fun
salt and
with
pepper's
that.
out
But
the window.
the fact is that you got to have a game plan, and you got to be diversified and able to do different things. If you're one dimensional, it'll work in a certain time, but then it won't work. So you got to have the ability to have not all your eggs in one basket, but to be able to prosper on all kinds of different areas. And we talked about that last, bonds, right? We had last week we did our talk on the fixed income market, which if in fact rates do come down, that can be really positive for bonds. And I read today that I saw somewhere, like, what did we say there was? We saw that there was like $6 trillion or $6 trillion on the sidelines. I
Yeah,
got a new number today, was like eight something, 8 trillion or plus. So that's a crazy
there you
amount of
go.
money on the sidelines. Everybody's wondering where that's going to go when it comes off the sidelines. We think we think it'll probably benefit, go to the next level of bonds, which then if it does that, then that'll as interest rates come down, that could be really beneficial for you. So all that said is diversify, diversify, diversify.
Absolutely, and it could be a very interesting springboard, for a risk on scenario once a lot of these geopolitical tensions, if and when they do clear up, after you kind of figure out who the president's going to be, Congress, things of that nature. Where is that again flowing down the pipeline? If those money market and cash, if a majority of it goes to bonds, and then from bonds, once things kind of clear up and uncertainty kind of fades a little bit more, that could be an incredible springboard for the economy and for the markets as well. So
Yeah.
again, all of this is speculation at this point because we don't have a crystal ball. Something could break tomorrow. Something could go really well tomorrow. We could get the numbers either way. So again, it's fun to do this with you and be able to kind of keep a real time pulse on it and see how this goes. But we really don't know. We're not wizards. We don't have a crystal ball.
Yeah, so it's important to keep your emotions in check. I mean, you get excited like, oh man, stocks are running. Let's go, Nvidia, Super Micro, all these different stocks, you can be up and it's great. I mean, if you have some of those positions, let them run. Like I said, those are good places to be.
Yep.
But when, you just got to keep your head about you, like, get too excited, keep the longer term view in your perspective, and you'll be just fine. So you got to stay. We talked about you got to stay like that quarterback, right? You got to stay cool, calm, and collected.
Yep.
When all the stuff around you is going nuts, you got to be able to keep your wits about you, focused on your job, and get it done, and stay even keel. That's where the great athletes are able to do in the tough times, in the high stress times. They stay even keel. And so I think that's really important for us as investors too.
Good points. Well, that's it for this week's Closing Bell. We'll see you next week. Thanks so much for listening, watching. Give us a call, shoot us an email. We're always here for you. Till next time.
God bless.